This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Welcome to the Texas Land Guys podcast. We have Tim and I today. Tim, how are you doing?
I'm doing good, doing really good.
We're sitting here at the end of February, and it actually feels like the beginning of the year was a really long time ago.
Yeah.
So I thought it'd be interesting to ask, even though we're only like a sixth of the way through the year, how the New Year's resolutions are going, or New Year's goals that we set like 2 months ago.
I feel like I haven't completely fallen off the wagon yet, so that's good. My wife and I had a little anniversary trip. Normally the two things that get me off are trips and being sick.
Yeah.
And I actually had both those happen at the same time. So last week, my wife and I were in Mexico, which was awesome. We had a really good time, but I got sick towards the end of it with something that was like COVID or the flu or something like that. I don't know what it was, but it felt like one of those things. I had a high fever and just felt bad. So I'm about maybe 3 or 4 days into sort of being well, but still feel tired and just don't feel the same energy. And it just kind of knocks you down for a while. So my lifting has been down a little bit because of that. But I've been pretty consistent lifting. And I was saying before we started recording, kind of a new thing I'm doing. I've always enjoyed barbell bench pressing. It's always been kind of a big lift that has been fun. I've never really been a big dumbbell presser before, but recently started getting into that. It's a little more technical, the setup, and when you go pretty heavy, it can be a little bit hard to balance the weights, but that's been kind of a fun new challenge, and I'm ordering some bigger dumbbells to practice with. So that's kind of kept it interesting and kept me motivated, coming back.
You sent a text the other day to David and I, and you were like, if you guys are in the market for like 80-pound dumbbells, Amazon's got a great deal. And I was like, I don't think either of us are in the market right now, but maybe. I mean, it's not going to be like a splurge buy.
Yeah.
But yeah, I think I told you I have like pretty good weights on that. And then I have a bunch of kettlebells that I like to use a lot. I kind of got into that last year after listening to one of Rogan's podcasts on like how he's like a huge kettlebell guy. And that's just something I'd never done a ton of. And so it's fun to change up a lot of your normal exercises and by just switching to kettlebells or dumbbells, and it completely changes the movements. And the Mind Pump guys that you listen to a lot and you got me into that are former or still personal trainers, but it's like the number one fitness podcast. They break down like all kinds of different workouts you can do with, dumbbells, kettlebells and all that. And it just keeps it like interesting because it's really important for your health. They say that strength training is like one of the number one things for longevity. It's so important to your future balance. It's so important to your future grip strength, to your muscle density, because as you age, you're going to lose muscle density. So just keeping it interesting is like so important. Otherwise, you're just going to fall back into the same old all the time. And your body also adapts. So you have to change it up. So it's smart you're changing it up. I feel like the more episodes we do, the younger you're getting. So it must be
I don't know about that.
All the things you're trying. People are going to wonder who's older between the two of us. And it's definitely you, but maybe you don't look like it.
No, I'm definitely older, but it's interesting. I think the neurological benefits of working out, there's definitely a benefit just from lifting and the resistance training. But I think also, like you're saying, when you switch to something like kettlebells, which can be really technical. I mean, there's a lot of different lifts you can do that are pretty hard to do. You can't just walk in, and lifting a 70-pound kettlebell is pretty awkward to do a lot of these exercises. And so I think there's a lot of benefit, neurological benefit, in addition to muscle growth, hypertrophy, and all that can happen through just learning something new, a new workout, or maybe it's the same movement, but a different weight so I think there's a lot of value in that. I haven't really done kettlebells yet, but that probably needs to be the next thing I do after getting into more of this dumbbell training.
Yeah. So. Back to your question though, for me, I think always thinking about with my goals for the year, health is definitely always one of them. And then outside of that, one of the other goals I had, and I think you mentioned this too on our episode where we talked about goals, it was just like relationships this year and really trying to focus on establishing more relationships, deepening relationships, trying to be more like if there's going to be conflict, because conflict is not necessarily a bad thing. You can have a lot of growth through it. Things just need to be confronted and said, trying to be better about just being that kind of a person, but trying to do it in a way that is thinking about the other person, obviously, but not just avoidance. Because I think in the past, there's a tendency, in like any part of your life, that you're like talking to your spouse about stuff that's going on instead of talking to the person, that there's challenges with or whatever it is, or a friend. So I've had all kinds of people around me going through different things the last like 6 months. And so just trying to have a lot of those conversations or more real conversations with people and trying to establish like longer term relationships. And also like I've been trying to focus on repairing relationships too. And so that's a big goal for me. And I've been able to have some really good conversations leading into the year that have encouraged me a lot. And I think that's something I want to keep doing, as the year goes on.
Yeah, it's really good. As I understand, we had a speaker at my son's school this morning. We had a little breakfast for the dads and sons. And remember Jay Brown? He's the CEO of David Weekly Homes now, but he was speaking on the power of the tongue and quoting the verse that talks about the tongue has the power of life and death, and just how important that is. And I forget which verse it was, maybe in a verse in Ephesians, he talked about, that we can use our tongues to build other people up. And it says according to their needs. So not just like what I think they need or what I want them to change or whatever, but like, what do they need? How can I help them? And using our words in a constructive way. And like you're saying, sometimes there's hard conversations, whether it's repairing a relationship or it's a confrontation of some sort. And those are very difficult. And it takes a lot of humility to go in and handle that in the right way. But I've been seeing you do that. And I've been real proud of you for some of the conversations you've had that are difficult conversations that a lot of people just wouldn't have, because in some of these cases you were hurt by people that they did something that hurt you that was wrong, that you could have easily had a justification to be like, I'm going to write them off and I'm not going to try and repair anything. And you've gone your way to try and repair those things and seek them out. And so I think that's really awesome. It's very hard to do, but it's awesome. So,
well, I think it's big to realize the responsibility that we have in relationships. And it's easy to get really frustrated with the other person and feel like I got hurt by them and even if there's reality and there's truth there, I think a lot of times both sides are actually hurting each other at the end of the day. And then walls can go up and there's not real communication. And it's incredible how communication ends up being probably the number one thing in all of life. It's like the most important thing. Cause like with your spouse, communication, to having good relationships, like it will not work without communication. It drives me crazy whenever I'm like watching a romantic movie with Jackie, like a rom-com or something. And there's just no communication in the movie. And you're like, if those two people just go talk to each other, then like all of the challenges would go away because they would have talked and be like, no, he wasn't cheating on her. Whatever the whole deal
whatever
is.
Whatever
the storyline is, it's like they just make sure that they don't communicate, and then all these horrible things happen. But that happens in like real life for sure. And it happens in business too. And sometimes you can't like repair things. But I think there's also the verse that talks about like, first of all, like living with your spouse in an understanding way, but then also as much as it depends on you, trying to live at peace with one another. And I think that you can't make people like you change, understand your opinion, but trying to be the kind of person that is trying to live at peace with others is important to me. And I've been reading James a lot, and I was texting you guys about it this morning because there's a verse that I thought was really relevant. And that book's an incredible book in the New Testament, but he talks about the tongue in there, and he talks about no one can conquer the tongue, which is such an incredible thing to think about. It's very black and white, very binary. It's like no person can actually conquer like what we say. We try to, but because of emotion and because of our own desires and wants and, a lot of our own needs that we prioritize over someone else, we just don't. And so it's like that idea of the golden rule. It's like do unto others as you would have them do unto you. We're really living that out. I mean, if we're really allowing the Lord to come into our life and the way that we're talking to others, then it will change, because the emotion's easy for me. Like I'm a very emotional, high emotion person. I can get very emotional in the moment. So that's something I've been working on too, is trying to just settle down and remember that God's in control, and remember that like my emotional response can do the damage in return to the damage that was done to me. And then you're just like part of the cycle.
Yeah. Well, and I think the justification that we have a lot of times to maybe treat someone the way they treated us in a negative way forgets the gospel. The truth of the gospel is that when I was Christ's enemy, he died for me. He loved me when I was unlovable. And when we can really get a hold of that, that love that he has for us, that's undeserved, then we can give that love to other people when it's not deserved. When they don't deserve our love or they've hurt us, and That's a very hard thing for me to do when someone's accusing me or blaming me or, hurt me in some way, to respond in love or to want to, have some sort of a connection or have peace with them and pursue that is like the opposite of what I want to do. I want to like either get away from them or just like crush them and let them know how wrong they are. But it's the complete opposite of the gospel. So
I was listening to a podcast the other day where he was talking about, and it's a guy that he likes to debate other people. So it's a lot of like debate. And it's pretty interesting when you listen to people that are good at having a debate, but it's not really about just being like, I'm right. It's about just being able to have a good, like, I'm trying to understand your position and I'm trying to explain my position, and I'm not offended and you're not offended if I don't agree with you. But like, I can ask you questions to kind of poke, and then I can also explain like why I just disagree, and both sides are trying to articulate that. But he's like, my point, because he was setting up his points because they were like going to be so opposite to the other person. And he's like, my point is, this is not about being right. It's about trying to get to the right solution together, but it's not about me just proving to you that I'm right. Because if you do that, a lot of times it's going to be so much more like emotion in that, and you're probably not going to get to the place you need to get to together where the other person's even going to see it, because they're just going to put a wall up. Because it's like, you're not really like listening to my argument. You're just trying to think about how you can talk about your argument. So we're not going to get there. Yeah, absolutely. Marriage teaches you a lot of that. Yeah, for sure. Yeah, that's one of the biggest blessings of my life was getting married really, really young, so I could learn a ton about that. And very thankful for Jackie. Yeah. Well, why don't we talk today about something that happened a couple weeks ago, the big national multifamily housing conference out in Vegas that a lot of our developer clients were out at, that a lot of the big capital groups go to every year. And it's really a place where multifamily developers will go. There's like a conference that happens, but a lot of it is there's just tons of meetings that get set up. And so developers will go, they'll take deals that they have under control, like under contract, and they'll present those to the big equity groups. And then they'll talk about portfolios and what's going on in their portfolios. The equity groups will talk about, their underwriting criteria for 2026 and the types of deals they're going to be looking at, maybe how they're viewing a different market like a Houston or a Denver or Dallas or a Tampa. And really it's coming back from that conference that it's always really interesting for us to talk to the developers and find out like what was the perspective. And it's depending on who you talk to, like some developers will go and they'll have 5 projects to present or 10 projects, like just in Texas, and they'll be spread across the state, and there'll be different projects like high rises down to suburban. And so you'll get like a pretty good comprehensive view because they'll have talked to so many different equity groups about those projects. And then others, won't have any projects, but they'll just be talking to capital, trying to find out like what's capital looking for. And so you'll kind of get, different reads based on that. So I thought it'd be interesting to talk about what we're hearing and what we are understanding capital to really be looking for in 2026. Yeah, I think that's good. We've had a lot of those conversations as well. And I think it's interesting because I feel like almost every year at NMHC, there's all this excitement and people come back kind of fired up, and developers come back and want to tie deals up. And there's a lot of positivity coming out of it. And sometimes that pans out and sometimes it doesn't. I feel like last year we had a little bit of a false start where we thought things were roaring back, in early 2025. And then especially when we got to kind of the tariffs and all that stuff started hitting, it really slowed things down. And a lot of deals ended up falling out. And the year didn't quite pan out the way it felt like it was going to pan out kind of in late January of 2025. This year, I've just heard kind of a different response, at least from the folks that we talked to that are active in Houston, that they just feel like capital markets are tight. Their words were more of a lukewarm conference this year, that people are going to be careful. And I think probably some of that is market by market. I think there are certain markets where there's more interest and there's not a lack of capital and there's not a lack of debt out there. There's plenty of capital and plenty of debt to do the right kind of deals, but there's concerns about underwriting, about fundamentals, about getting deals that have a really good story that feel like they'll be the successful deals. And so I don't know what you're hearing up in Dallas, but it was I would say a fairly kind of lukewarm response for our Houston developers. Yeah, I think it's similar. And in some ways, this probably sounds a little bit crazy as a land broker, but I kind of appreciate it because it just seems more honest. As much as I would love for the market to be on fire, I remember last year we were out of town. We were out working on like fundraising for Ascent. And so we were out of town, and it was during and around the time of NMHC. I think it was right before, it was like a week before. So it was like late January. And I just remember it was like my phone was blowing up, multifamily developers, mean, literally every site we were taking out to market was going under contract and getting offers in Dallas. I think we had 19 just multifamily deals go under contract in Q1 of 25. I mean, it was just crazy how fast the market was moving. And then so many of those projects fell out of contract at the end of their due diligence period. Some of them never even officially went under contract because a lot of it was groups were, doing that to then go out to NMHC and shop them around and kind of like have something to show. There's a lot of that happens. But then the other part of that was tariffs happened and things changed in the market and it just wasn't this big event. So what were people thinking about last year? Interest rates are going to come down. The whole supply demand story is going to change. So we're going to start to see supply roll off. We're going to see demand increase. We're going to see rents come back up. And then that didn't happen. And so I think we're realizing that's just going to take a lot longer to happen than we thought. And so now in this year, hearing that, okay, there's interest, but it's going to be more of a cautious interest. Like there's plenty of capital. I think that came through very clear. There's like 7 multi-billion-dollar development funds out there. A lot of them were recently raised and they raised above target. So they went out to raise, $2 billion and they were able to raise $3 billion. So there's all this capital out there to develop multifamily across the country, but it's going to be deployed very cautiously. And a lot of that has to do with they're not seeing the rent growth. In a lot of places, unfortunately, we're still seeing pretty significant concessions. Like at lots of Dallas, in the whole DFW Metroplex, you have 2 to 3 months free rent. So you can go live in an apartment complex for 3 months and not pay rent. I mean, it's not good. And so you're seeing that because there's so much supply. And so until that changes, it's really difficult to justify really development. And so the projects you are seeing move forward are kind of, you're having to look at a contrarian view of just the fundamentals of the market. So yes, there's tons of capital out there. We believe there's going to be a lot of growth. The one metric moving in the direction that we want it to is construction pricing. So even kind of the most obstinate developers I talk to that love to tell me that there's no change in construction pricing, it's like they love to argue that like we're not seeing any change, even though everyone else has been seeing change for like the last 12 to 18 months. Even now they're telling me, well, yeah, we're seeing a little bit of change. That's significant because if projects are now costing $10 to $15 million less to develop, I mean, that's for sure the land value. And then even some to hopefully start making those projects make sense. But that's kind of the only metric moving in the right direction right now from a multifamily standpoint.
Yeah, it's been disappointing in Houston. Our fundamentals have been pretty weak, even though supply has been low, much lower than what you guys have up in Dallas. And even areas like the infill market, the Heights and Washington, these different pockets have been really hot historically. The Washington corridor, Sawyer Yards area has been really soft. I mean, we're almost seeing like suburban level rents in the infill market there. The Heights has been a little bit better, but just a soft market and a soft market in a lot of the suburban submarkets as well. So there are some active developers who are doing deals. There's definitely some contrarian views, which I think are really smart.
Yeah.
I mean, this is a time you want to do deals when it's hard to capitalize deals, when the fundamentals aren't that great, when everybody's on the sidelines. You want to go get deals capitalized. It's going to be a battle to get them capitalized, but get them done. And then those deals will be delivered into a market where there's not a lot of supply. And hopefully you see rents start to come back up and you see the fundamentals improve, which I still think is going to happen, across all these Texas markets. But I think to your point, we are seeing construction prices come down, which is very helpful. And then, the debt is there. And it's kind of funny because a couple of years ago, you couldn't get debt, but you could get equity. And now you can get debt. We had a client who just took a deal out and got 6 term sheets from the 6 banks they went to. So they had no problem getting debt. But then they had one of their longtime capital partners pass on a deal. There was a deal that underwrote. There was they thought a middle of the fairway kind of deal that would have been easy to get done. This group passed on it. So there's definitely a struggle of having to dig a little bit deeper on the capital side and having to have sites that have a story where there's something special about it. There's some perceived barriers to entry, some strong employment around it, just something to say that like there's a reason to go do this deal versus other potential deals that are out there.
Yeah, I mean, I think what capital is going to be focused on if it does deploy, because you can't ignore just a lot of these legacy issues. And by that, I just mean the hundreds of projects that these big institutions invested in the last couple of years that haven't panned out, because they invested in these projects and now they raise those funds promising a certain return. They're still holding those deals a couple of years later and they're not able to sell them. A lot of the comps we're seeing on multifamily developers that are forced to go sell a project right now are just so below replacement costs that it's concerning, or they're not below, but they're not at a level that you can really justify another project. So there's certain areas of town that are just like off the table right now. And then there's other areas of town where I think there's a really good argument, but those are like the very core areas. And so capital is really going to be focused on those core areas. And even if we see rates start to come down, even though I don't think that we really expect that to happen, or we don't expect it to happen in really any significant way. I was talking to a suburban developer that reached out, and this is a property, that is not a property you could sell today. Like you could have sold it, 3 years ago easily, and they could have done really well. And they reached out and they're like, looks like rates are coming down. Looks like this will be a great time to sell. And we did the call with them. And we're just like, it's not. I mean, you can sell, but you're going to be selling to an investor. And they couldn't believe it. Yeah. And then we walked through the market, and we walked through how many of their multifamily projects are under construction, how many are planned, what the rents are across the market, and how in that specific submarket, you really couldn't justify developing anything. And they were just like, wow. Well, and I just told them, look, I would hold in this case if I was you, because they can hold. It's like, you don't want to really have to sell into an investor market if that's your only exit. I would hold in that case. And that's going to be the reality for parts of the market. And then those core locations, you're going to see the opposite. You're going to see just a ton of demand. And so some of these sites that we've taken out early this year, and I wouldn't even say that some of them are core. They're kind of like, in core areas, but they're not necessarily like a main site. Because they're in core areas where there's been less supply, we're getting really strong interest in those. But then in the other ones, there's just not really like any interest in the market. So it's just two completely different markets.
Yeah, it's so interesting because what you're talking about is you do have a lot of capital. You don't actually have a lot of developers, but you have a lot of capital. So they're all going to pile into like the good deals. So if it's a good site, good story, good submarket, everything's good about it, and it's a real deal, that site will actually get bid up. That could even go for a record price. That's going to have a lot of offers. But then you have these other sites. Like I had a conversation with one of our sellers last week. And when you talk about going from a developer price to an investor price, just the audience knows, you're not talking about sell for 10% less because it's an investor. They're going to do a quick close. And this guy was kind of saying that like, hey, I'd take 10% less for a quick close from an investor. And I was like, that, unfortunately, normally an investor price is 50% less.
Yeah.
If you want a quick close. And the hard thing about the development market people understand is if it's kind of a fringy site or what we might call a commodity site, which are out of favor right now. We have had markets where those sites could get capitalized and those are in play. But right now they're not. It's almost like you just turn the lights out. And so it's not a question of if we took a little bit of a discount or if we gave some a little bit more time. There just may not be a real developer to work on that right now just because there's not capital for it. So it's more of a question of being offer on versus how much less would you take for it. And I think people just don't quite understand that. I think that they assume there's a lot of buyers for my property. And if I were just willing to come off a little bit on price, then I'm going to have, as many buyers as I want, and I can just easily sell it. And unfortunately, it doesn't work that way on a lot of these deals.
Yeah, it's not a deep market for a quick close from a developer. I mean, there's like a couple groups that could do it, but if you're a developer and you can close quick, then you're going to want a discount to be able to do that. Yeah. And then the problem is if those few groups pass on the site, because they're also very selective, because if it's their own money, that's how they can close quick. They only have so many arrows they can fire. So if they fire those arrows, they're done. So they're going to be really selective. If you don't get those couple groups, then like you're saying, there's just like precipitous drop to the investor price. So you're kind of stuck. You're either going to sell and really need to give someone time, or you're going to have to take a pretty big price cut on the land. So I think that's kind of what we're hearing, at least related to multifamilies. It's going to be very core focused. I think market to market in Texas, Dallas is definitely considered, the DFW area would be considered the top area. But like I said, I was meeting with a group the other day, and the comment the guy made was, he's like, the multifamily developers are bleeding on their knees right now. Because, when you're giving 10 to 12 weeks free, that's really terrible. Really terrible. That's really difficult. So multifamily is definitely not easy in DFW. It just happens to be the most robust market right now. To me, as a investor, but as someone that if I was out building apartments, I would be really interested to go do something in Houston just because of the fundamentals of Houston. Houston always kind of gets a knock because people consider it just more volatile because it's had so much volatility in the past. But when you look at just the supply in the other parts of Texas, and even just the competitive landscape, it's so much more competitive to go buy sites in like Dallas, and has been in Austin. It's not as much today, but because there's so many developers out sniffing around, there's so many developers we meet with here that don't even have Houston on their radar, which I think is a huge mistake.
Yeah, we really just see, I would say, almost like a handful of very strong developers who are really leaning into Houston and looking at deals, making offers. It's pretty weird. I would say one of the only times in my career that I've actually seen so many groups on the sidelines. There are legitimate developers that have been strong kind of, every cycle in Houston that just aren't even trying to do anything, which has been kind of weird. But I was going to ask you about Dallas. Do you see a fairly strong investor, market right now for some of these sites? I mean, if someone was willing to sell at an investor price, I feel like in Houston, we do have some investors, but that's become a pretty thin part of our market. We don't really see that many real investors for land. It feels like in Dallas, there's a little bit more of a stronger investor contingent that kind of snaps these sites up if they get within a certain price range.
I think there has been. I think that it might be changing a little bit, only because that was a very, very, very healthy market. And then with the adjustment we saw, because you have to look at, and maybe Tim, it could have a lot to do with what's happened in the last 15 years. So we've talked about the volatility in Houston. And so if you were trying to be that type of investor in Houston, it's like it's cold, it's hot, it's cold, it's hot. So unless you perfectly timed it, you could really have gotten crushed. But if you were investing in Dallas or Austin, it was like a 10+ year run of like,
you couldn't do anything wrong.
Just growth. So you have these guys that were investing, and it was like, buy a property, sell it for 3x, go a mile north, sell it for 3x. And they just kept doing that. But then all those guys that bought in 21 and 22, very prolific. And not all of them. Some of them have been able to get in and out because they were able to buy really well-located sites and they were just more sophisticated. But a lot of the developers that were making up this like very speculative land investor market, especially in the northern suburbs of Dallas, a lot of them have really had to kind of take a step back. And it's similar to how the big institutions have these legacy issues. It's because they have legacy issues. So a lot of them now own land with debt. So they're more focused now on extending their debt or recapitalizing it. So getting other investors to come in and, try to pay off the debt, recapitalize it, than they are on buying new land. So like there's still an investor market. Like there's good sites. We have a really good site that we're working on that's up by the TI plant in Sherman, like right off 75. It's an incredible investment site. So like if you have sites like that, there's going to be demand. But what was happening was just like every site in the middle of a field in the northern suburbs, they were just looking at it like, well, what's the price? And if it was like $5 a foot and less, then they were just buying these sites and then trying to sell them for $10 a foot, and that's definitely gone away. And so it's a lot more sophisticated now. And so it's changed to, okay, well, now we need to be like off of a specific corridor. Now we need to have utilities, like just a lot more sophisticated, working with engineers, making sure they know what they're biting off on. So I think there's definitely still investment happening. And a lot of it is foreign capital and foreign investment. But because the last couple of years have been more challenging, we've definitely seen a big shift from where it was. Because there was a while there when the market was really hot for development in 21 and early 22. And so land prices were going up and you saw developers really getting aggressive. Like developers were paying much bigger numbers than they are today. I was still getting beat out by investors on land sites. Like the investors,
as I was going to say, not just investors paying more. They came up to like the developer pricing, which really showed you that there was a problem when it gets like that.
So like those deals we lost out on back in 21, where we were like stretching. I remember a deal specifically that was pretty far north, Salina. It was like north of the high school, which is pretty far north for multifamily development. We were stretching and we got beat out on price by an investor that also closed in like, 60 to 90 days. If they still own that property, like I probably couldn't even bring them an offer today at half of where we were back then for that property today. It's just, that's how much the market's moved. And so you have certain parts of the market that are just really difficult to go do deals in. And I think the way you have to look at it, because I've talked to some of these landowners in some of those areas, they're just really oversupplied. The way you have to look at it is it might not come back for like 3 to 5 years. So just make sure you're ready to wait, and that you're comfortable waiting, because it might be better to sell for what you can today or just wait 3 to 5 years. But it's not going to change like next year. It's just not going to be back that quickly in those areas.
Yeah, and your carry costs. I mean, if you have debt, and then if your property's not an ag, you have some serious carry costs. So you're going to be 30% higher on your value, on your basis if you wait 5 years, maybe even higher than when you bought it. So even if you do see the market come back and get stronger, there may not be any money there at the end. You may just be trying to get your basis back, which is pretty sad for a lot of those people.
Yeah, I mean, it's part of the land business. It's pretty crushing as a broker. If you've been trying to get a listing for a while and then you get the listing, but it's actually a deal that you're not going to be able to sell and you're just wasting your time. And there's definitely a lot of those that we've seen come to market where these landowners are not willing to come off the price and it's probably worth half of what they're asking. And so that broker that's working on that is not going to be able to sell that property. And unfortunately, the way it's structured is really it's just up to the broker to say no, but you're working for free until it closes. So that makes it tough. But capital was looking for basis. It was get me cheap basis. I want to build as cheap as I can wherever I can. And that's just, that was great for land because there's a lot more land that you can buy for cheap than there's land that you can buy in really good locations. And it's just completely flipped now. And so it's back to the really good land. And the cheap, inexpensive land is not the same market today for a developer.
Yeah, what you're talking about there is the attainable product or kind of A- product that a lot of groups are building very prolifically, where they're buying a cheaper site that was more of a commodity site. It was kind of in the right market, but maybe not on the right street or just not as good as a really core site. But they could get it cheap and then they could build a cheaper product and then get rents high enough where the numbers still worked. And that's really fallen out of favor. Probably it's been about 12 to 18 months that's kind of been out of favor. And so now you're going the other way, which is to these, kind of Class A plus, deals, these expensive deals that you can actually build cheaper now and that are at the core locations where you feel like there's some defenses built in from a lot of deals coming in around you and you feel like you can be successful with that property, which was funny because we weren't seeing as much of that in the last couple of years. Now we're back to that. In Houston, the deals we are seeing are those kind of deals. And in some cases, it's record pricing, which is kind of crazy to see that because you wouldn't think this is a market where you see record pricing, but we're seeing some very high, almost infill kind of pricing on really far out suburban sites, just because those sites have a really special story and they're a great opportunity. There's enough capital coming in, kind of fighting for those deals to really push the value up.
Yeah, I mean, a couple of thoughts on that. One is those sites you're describing, those kind of urban, suburban, those good locations, they're getting better rents than these urban markets. But the construction type is so much less expensive to build. I was talking to a developer that really well. I'm not going to say his name, but it's based in Houston. And he was looking at some Dallas stuff. And he was just nobody wants to live in the Galleria anymore. And he was just he was he's been developing a long time in Houston. And he's back in the day, everybody wanted to be in the Galleria. And now nobody wants to be there anymore. And if you wanted to develop in the Galleria, you're probably going to be paying $200 a foot for the land or more. You're going to be building a high rise. And it's kind of laughable because you could go out to an area you're talking about, pay up for the land, get the same rents, but what you pay for the land is a fraction. I mean, when you're talking about paying up, $30 a foot? Maybe?
$30 a foot is just coming out of your shoes.
That's coming out of your shoes,
20 to 30 a foot. And then
you're building
saying,
surface park.
Yeah, surface park versus high rise. I mean, you're talking about extreme, half the cost or maybe less than half the cost of the actual building, let alone almost a tenth of the cost on the land. But you're right that the rents, maybe the rents are 30% less. So you can see why that's where the money's going, and they're not going to these really high price infill sites.
Well, I think that the other thing I was going to say was that makes perfect sense, like what you just described as a strategy. But I think in general, capital, when we talk about capital, is big capital. It's the institutions. They're driving this back to main core. It's the herd. The herd will follow that. So what's fallen out of favor that you said, these attainable projects, there's a couple groups that are still doing them. And I think it's really smart. Yeah. But the challenge for them will be raising capital. But it's really smart because the contrarian play is really going to pay off, because the challenge with following the herd is you better just be at the very front of the herd. Yeah. So you better be leading the herd. If you're following the herd, that's where you get oversupply, and it just flips. So it'll go from suburbs are oversupplied. Now urban's oversupplied. So now we're going back out to the suburbs. And so there's some really good, developers that we worked with over the years that were just willing to be, or really, I should say able they were able to be contrarians because their capital was more private. And so it just allowed them to back up and work more strategically in the market. They weren't, handcuffed to what does this huge institution think I should do? And it's not that the institutions are making bad decisions, but they're looking at everything so differently. If you're a developer that's really trying to go do a deal that just has outsized returns, trying to follow everyone else, and you know how it is, what really happens is institutions say, we want to be urban. And so there's like a few groups that are actually going to be able to go get stuff done. And then there's all these guys like trying. And so they're like trying to tie something up, and then they're going to go shop it to the institutions. But it's like too little too late because there's so many other projects already in the works. And so I think that's the difference of like, where's capital want to be versus is that actually going to be where a developer should go to make money? And those are my favorite conversations to have with our developer clients. I love it when they're like, where would you go? Like, where would you go do 3 deals? That's my favorite thing to go talk about is like, where would I go do 3 deals right now? And I always am like, ready for that answer. So that's what's fun. But it's also going to have a lot to do with what's your capital structure. Because I can tell you like, these are 3 areas you can go make a lot of money, but you may not be able to get your capital to buy off on it.
Well, I think what we're seeing is a flight to safety. The capital doesn't want to take a risk, and they're thinking, these sites we're talking about, it's a suburban site. A lot of times there's walkable retail that's really nice, really high-end demographics all around it, kind of main kind of locations. But you start paying $30 a foot for a surface park site, and then you're building a really nice product. And then you have sites that are maybe, in some cases, a half mile away or a mile away where it's $6 dirt or $7 dirt, or maybe it's $8. And you can build a much cheaper product. And you're not going to get the same rents. There's maybe some lease up risk. There's definitely going to be a different cap rate on the exit, but if your cost is much less, in some cases, especially in Houston, you don't see the rents go down that much. Maybe they're 25% less or 20% less, but the economics are so different in your all-in cost that I think you're right. It still makes sense if you know to execute these attainable deals to go do those deals. I think the problem is a lot of groups don't know how to execute them. Yeah. And they can't build a nice enough product cheap enough. And then also you got to really be smart on the location, because there's some locations that are just not good locations, and there's some submarkets that are bad submarkets. And what we try and do is find where are the submarkets where there's still opportunity, where the sites are good enough that we feel like it's a good opportunity versus the ones where you really just want to stay away from it.
And that's definitely in Houston. You guys know it so well, but when you don't have zoning and you have either side of the street you're on, it can be very different. Obviously school districts, easy to pull up and look at, but that has a ton of value in Houston. But also just because of the lack of zoning, there's certain areas that are like, if you're from Houston and you're trying to target someone paying higher rents, it's just not going to happen, in those areas. And I remember, developers coming in from out of state back when I was working Houston and making some buys that they thought were like incredible. And I remember we couldn't believe it, couldn't believe that they had all kinds of issues, a lot of credit issues, like tenants coming in and couldn't pay rent or wouldn't pay rent or moved in, just crazy stuff, all kinds of crime issues. And we would have never advised them to go to those locations. And some of these were they paid up to go to these locations, and it's in Houston, because I lived for a long time west of the Galleria, it would be just the difference of, you lived on a north-south street between 2 east-west streets, just the difference between going just a little bit south, maybe 500 yards is the difference between a project working at all and a project working.
That's such a good point. Understanding the different submarkets, because you can have that same kind of B site, commodity site. It's actually a really good market that's going to work really well. And then you can have it just be a total disaster. And Houston's the best. We have literally being on one side of the street versus the other can completely change the deal. And there are certain submarkets and then there are submarkets fall out of favor. And then there's some that are getting better. And so there's just a lot of nuances to it you have to really know and be careful of as a developer.
And I think that's probably a big part of why capital also struggles with Houston. It's the volatility, but also the lack of zoning. And I think knowing it as well as we know it and as well as you guys know it, you can guide the developer to the right locations. And that's why you see the really good developers that are, most of them in Houston. I'm sure we could. I don't know if I can think of anybody that's not a Houston developer that's would be on the top developers in Houston list. They're all right. Houston developers, but they really know the city. And so they really understand the neighborhoods. They understand where you want to be. And a lot of them have been there for, decades and done really well. But I think capital, to your point, it's reducing risk. It's the willingness to go take a lower return if it just feels really safe. And that's probably going to look like DFW in Texas in 2026 and maybe even 2027. And then what I don't really understand about the view of Houston is with how overbuilt Austin is, I could still kind of see Austin swinging back above Houston. Like Houston will stay above it for a while, but then there's just going to be this demand again for Austin because Austin gets all this hype and all this demand, even for such a small market. They get so much hype and demand.
Yeah, I agree with that. I think we'll see that. I mean, I think Houston, San Antonio will probably just kind of be steady, and you'll see both those markets are probably more local markets. And they're national developers doing deals, but they're local teams, those national developers that really understand those markets. And then I think you'll see Austin and Dallas continue to get a lot of out-of-state developers and just, foreign capital. They're just going to be frothier markets. And I really do see Austin as like the new San Francisco. I think you're going to see it just get hot again and completely turn around. I think we're contrarian in Austin. We bought some sites there that we're excited about. And I think it's just a good buying opportunity because it's so beaten up right now. But I think you'll see population growth and job growth, and it'll become a healthy market again.
Yeah, I mean, it's interesting about Austin. We were talking about that the other day on what we've bought on the Ascent side. Austin's outperformed every other market so far, which is really interesting because it was obviously really hot and then really cooled down. But our timing to buy was we've pretty much bought for the most part when it was really elevated from an activity standpoint. So I think Austin, that's definitely the case. And I think that people will probably, again, give it more benefit of the doubt and come back into Austin earlier. And so Tripp's already been saying that they have more and more developers coming and meeting with them again and wanting to do projects in Austin. Even though if you looked at it today, you would say, gosh, it's hard to justify going into Austin, or at least different pockets of Austin. But I think the belief that, that's where I was talking to Got Breakfast about it. Like that's where Elon has wanted to build his entire ecosystem is down there. It's not up here in DFW. Like we've missed out on everything that he's done in Central Texas, and he's not done investing down there, and he's not the only one. We have all these other big tech companies, and everybody kind of seems to want to be down there. Not that we haven't landed plenty of big corporations up here, but there's so much going on down there. And you bring up San Antonio is so good to bring up because San Antonio just doesn't even get mentioned. And I'm talking about from our developers. I think people from San Antonio would be very offended to hear that. But when we meet with developers from all across the country who are talking to all the big capital partners, if you were out at NMHC, I guarantee you that San Antonio was not being mentioned. Like that wasn't leading anything. You're going to have to bring that up to these big groups because it's a massive city. I think there's a lot of opportunity, but they've never had the same growth from just an economic standpoint and the same job base that you have in Dallas, Houston, Fort Worth, and of course, Austin. So it's interesting though that really just the opportunities again, back to where capital wants to be, big capital, institutional capital, and then where private capital can go deploy and you could go do really well. I think San Antonio is another one of those kind of sneaky markets because they haven't had as much development, but they have a huge population.
Yeah. What's your outlook? I mean, do you think the NMHC is right with kind of this outlook that we've called kind of a lukewarm outlook or kind of a careful outlook? Do you see this year, that kind of bearing true this year, or do you see things shifting somewhere in the middle of the year and multifamily specifically, coming back stronger than what is anticipated?
I think that's probably right. I think that, I was talking to a developer yesterday that was saying, by the end of the year, it's just going to be on fire again. I was like, I don't know that that's true as much as I want that as a broker. I think that if you just look at what's going on right now in our country, if you look at what's happening with AI and just some of the uncertainty that these big capital groups are having to deal with, the only way it comes back on fire is if the big capital groups come back in and really want to deploy. It's not going to be private capital. There's just not enough of it. So it's going to be the big institutions. And I just think the institutions you've mentioned consumer spending a lot and just some uncertainty with what's happening with AI, what's happening with jobs, all the advancements there. I just think it's going to be too hard for these institutions to get really excited about investing a ton in development until things just start to look a little bit better from a fundamental standpoint. And I think it takes longer than we have this year to just churn through all the supply, just all these units. The 10 to 12 weeks free is in a lot of different areas right now of DFW. And I know it's also in Austin. So I would say that I think site by site, that doesn't mean that you can't sell your site and you can't get a great number, because we're seeing that. Like, we've launched this year, first 2 months of the year, with a ton of new listings, just a lot of landowners, a lot of developers saying like, we want to sell in 2026. And I was looking at it earlier today because we had a site out to market. We did a BOV in December. And I was probably feeling more bullish in December about 26 than I feel now, just about kind of what's happening in the market. But we've actually hit everything in that BOV and we're above our premium value. And we've got, we're going to have close to 10 offers on that site. I just think that's going to be more rare though. Like, I don't think there's going to be as many of those type of deals this year, but I think that they're there. And I think those are, if you're getting called by us, a DMRE, to work on your property, because we believe that it's those kind of deals, because we're not going to go waste our time in 2026 trying to sell sites that just can't be sold. I think there's going to be a lot of brokers, unfortunately, that are still kind of believing that it's going to really ramp back up. It's worth taking a site out at 10 million, even if it's worth 5 million or 6 million.
Yeah.
And they're going to try to do that. And they're going to get offers for the owner at 5 and 6 million, and the owner's not going to sell. And I think it's just really important as a broker to be disciplined in what you're working on. And then as a seller, I would go to market if you're willing to be realistic and meet the market. Don't go to market if you're like, I'm stuck on my number and everyone's telling you that number just doesn't work.
Yeah, I think the prediction of what's going to happen for the rest of the year, you have to think about what are the big factors that could shift the story. For example, if rates were to come down significantly, right now it looks like the opposite is going to happen with Warsh, being appointed. He looks like he maybe is more hawkish. The Fed as a whole looks more hawkish. They're not going to maybe lower rates that much, but that would definitely change things if they really dropped rates. That could get institutions back in. If we had a big uptick in leasing velocity, maybe this summer, if we just started seeing much higher rents, or if there was a lot of job growth that happened, which I think would be surprising right now, but maybe something like that happened. So there's probably some things that could happen that could shift the narrative, quite a bit. And it's funny how I've learned so much throughout my career that you sort of have the belief of what the future is going to hold in the near term. And you have a lot of times really good reasons why, but then a lot of times you're still wrong.
Yeah.
And something different happens, or there's some surprise or something you weren't looking for. And so you have these headwinds out there, like you mentioned, AI, that could cause a challenge in the job market or in other ways. But then you have other factors that could be positive. And so it's just hard to know how those balance out and how those shift, throughout the year and how that impacts these deals.
Yeah. And I think it's back to what we were saying. It's two separate markets. There's going to be parts of the market in the land market that not liquid, very difficult to sell. Your market as investors. Then there's going to be these other opportunities and sites where you might be able to sell for more than you ever could have sold, for the simple reason that there is a ton of capital on the sidelines. It wants to deploy, it has to deploy at some level. It's just not going to go make mistakes and stretch on deals. It's going to be really disciplined and focused. So if you have one of those sites that fits that criteria, everyone is going to be focused on that site. Everyone. And because everyone's focused on it, like we've actually seen recently, there's one of the big real estate REITs. They're really active right now and trying to build pipeline in the DFW area, like buying land for development. They're stretching on pricing like way beyond. It's like, that's a function of if they find something that works. Like, to me, it looks like way beyond, because, I'm not the REIT and I don't understand that whole period and like their long term, the way they're viewing it, and that they're going to have now a development pipeline of like several phases and projects. But for that specific landowner, he's getting something that's way higher than anyone else in that submarket's gotten, is getting, because that specific buyer was really focused on that. And we're seeing that on these really good sites. Like, if you have a really well located site, but it can't just be like the 5th high-rise site in a submarket. It's going to have to be unique, like high barriers to entry. Maybe a site everyone's always tried to buy, landowners finally willing to sell, just, those type of sites. It would be a really good time, I think, to actually take it out, because there's going to be a lot less competition from other good sites, because there's just not a lot of them that hit that criteria. And so you're going to have so many eyeballs focused on your property.
Yeah, that's good.
Is there anything else that you would say about just Houston and what you think, how you think that plays out? And if you think that just the lack of supply you guys have had from a multifamily standpoint, if something changes there, or if the future in Houston is, like, I know you guys are doing a ton on the single family side. So do you think that there's just a lot more activity on the for sale side, and that's going to flip at some point? Or what are your thoughts as to why that's the case?
I think that we'll continue to see single family stay strong, at least for a while. And to be clear, it's not strong is a relative word to last year because it was much stronger at the beginning of last year than it is today. There's still, the builders have pulled back quite a bit, but lot developers are pretty aggressive just because of how long that time frame is to get deals entitled and get utilities in place and actually put lots on the ground. So that it's a fairly healthy market, even though we have seen actual home sales slow down. Even though seasonally they slowed down in January, February, they've slowed down even more this January, February. So I think that's concerning. But on the multifamily side, I don't expect any major changes this year. I think that we will see the strong developers do deals. And I think they're going to do the deals we've talked about, the well-located deals. I think they'll get them capitalized. I think we'll maybe see some infill deals. I think there's some very credible developers who are looking hard at infill sites, and they're willing to pay what is really good pricing compared to the last couple of years. They're willing to pay 120, maybe 150 a foot for a good site, which is maybe not as high as it was at one point, but still really good pricing. But I think we're talking about, maybe 1 to 3 of those deals getting done this year, and maybe they close next year, but go under contract this year and get capitalized this year. So I don't think we're going to see things roaring back. And we do, even though we haven't had as much supply, we do have very soft rents. I mean, there are certain places where the rents are good, but there's a lot of places where rents are very weak. Even going back, kind of historically, they're weak. So I think that's going to have to switch. We're going to have to see rents come back and things tighten up a lot for developers to change their posture and be much more aggressive.
Yeah. Well, it'll be interesting to see it play out because I do think with Houston being such a enormous economy and just such an enormous city, I mean, Houston, greater Houston, just everything that encompasses now, there's definitely going to continue to be a need for housing, specifically for apartments. And so the developers that we know really well that are going to never really stop, developing there. It's just difficult depending on the year. But, I think probably because I lived there so long, I always try to argue with you guys a little bit in meetings with developers on why they should be looking down in Houston. Because,
we appreciate that.
So many of them just kind of blow it off. But I do think there's a lot of opportunity down there. And there's some really good developers based in Houston that have done really well too. So
absolutely.
But I mean, for our audience, if you're listening and you're a landowner and you're interested, like how would capital look at my property? So obviously we have Ascent, which is our internal investment fund, land fund. And so we can look at it from more of an investment standpoint. And we talked about there's going to be parts of the market that are investment buys right now. And ours is obviously all private capital. We don't have any institutional capital. So we can be very flexible. We can be very contrarian. And to your point, Tim, bought a property in Austin in December, super contrarian play. Not many apartment land deals were trading in Austin last year. And then also we can tell you what the big C capital, like the institutions would think about your property. Is it a fit? When might it be a fit? And help you evaluate it. I think that's something we like to do, Tim, is if it's an apartment site, I think we feel like it couldn't be more down the fairway, bread and butter, like exactly what we know. Like I just love looking at apartment land and talking to landowners about you should phase it. This is how you should look at the construction. Maybe you could do like different property types on it, like just all the different things you can think through on tract. And of course up here, really thinking through zoning and like, are you factoring in the zoning risk? And I was talking to a landowner yesterday about, he's saying, I got a higher offer. And I was like, well, is it for apartments? And he's like, yeah. And I was like, well, yeah, you got a higher offer for apartment. It's like a townhome site, but you got to, and I'm like, but it's about zoning. And, and he's like, I think the city wants apartments. I'm like, well, we'll see. Well, I can definitely
don't.
I can definitely bring you a higher offer from an apartment guy, but then you have to decide, do you want to go through, a year to find out your project did get approved? But just helping think through that. Like, I think we love doing that. And so reach out to us. Let us help you out in that area. We have, it's not just Tim and I, obviously. We have a lot of really great brokers that work for us across the state. And whether it is San Antonio or Houston or Austin or Dallas or Fort Worth, nobody understands specifically multifamily. Nobody understands it like we have. I mean, just 400 multifamily closings, over 400 multifamily closings. That's a lot of reps. And we've obviously worked on a lot more than those 400, but those have closed, which is pretty incredible and really a huge blessing.
I think that 400 can kind of roll off the tongue, but each one of those is a big deal. It's a hard fought deal. They're all institutional capital or, they're high net worth, family office kind of capital, but those are $50 to $100 million deals when they're built. And so they're major deals, high-rise deals, surface bar deals, wrap deals, podium deals all across the state. So we've seen just about everything from a multifamily land standpoint. And like you said, we get excited about it because we know it so well. It's really fun for us to work on those kind of deals. And we'd love to talk to you about about your land if it could be a fit.
Well, thanks, Tim. Great conversation. And I'm hoping that 2026 ends up being just a year that's on fire. But I think we're working on a lot of exciting projects either way. And I think we've done this long enough to kind of know what has a lot better chance of getting done. So I think it'll be a good year, but it is interesting to hear what capital is saying, just as we are really now getting into, the meat of the end of the first quarter.
Yeah, absolutely. All right. Thanks, Tom.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.